Today's episode is brought to you by Security Financial Management.
Welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio. Here as always with Dave Allen, Mitchell Allen. We got the father-son duo today. Gentlemen, what's crackalacking?
What in the wide, wide world of sports is going on here?
Let's get some positive energy today with this segment. Give me something good.
Hey, give me something good.
Today, Dave, I'm stealing one from you, brother. I heard you say this earlier today. It says, happiness isn't getting all you want. It's enjoying all you have. I loved it.
That's so true,
awesome.
though.
Yeah, it's hard. It's hard to do that.
We forget to do that. We're always in pursuit. We're always in pursuit. Always always got another project, always something to do. Hey, sometimes it's just good to sit back, smell the roses, enjoy what you have.
Comparing yourself to anyone is probably my biggest nightmare.
Oh, yeah.
I'm terrible at it. I'm like,
Yeah.
oh, where'd you get that watch? How much does he make?
Yeah, I want one of those. Why can't I have one of those?
Yeah.
Yeah, I mean, it's just, for those with aging parents, you got to enjoy your family.
Yeah.
For those in retirement, you got to enjoy your money.
Yeah.
It's as simple as that.
Got to spend it.
Got to spend it.
Guess
There's
what?
So
If
many
you
people
don't-
that don't.
If you don't spend it, guess what? Somebody else is.
I will.
know.
No question.
Is that what you say to your dad? Hey, Dad, please don't spend all my money.
Chill on that, man.
Hey, man, you
I
can't,
need that belt.
you can't afford that, Dad.
No, if I said that to him, he'd give it all to charity. Just the
Or just spend
backstab.
it.
Yeah.
It's hilarious.
All right, let's get to the question of today. Today's question comes from John from Claremont. John, what you got for us?
You want to say something?
Hey guys, John's question is, what is Security Financial Management's thoughts on the recent market volatility? Is this something he should be concerned about?
Thank you, John. Dave, take this over for us, please.
All right, John. Hey, thanks for your question, buddy. That's probably one of the most brought up question right now is, should I be changing my style of investing during this election year? But the reality is, Mitch will make fun of me here, is we never let the politics tail wag the dog. What do you think about that one, Mitch?
God, I hate that saying.
Mitch hates
It
that
makes
saying.
sense. I mean, the baby boomers love their idioms, but boy, do I hate that saying.
What's the other one you hate?
Throw the baby out with the bathwater.
Ooh, that's a good one, too.
Throw
Kick the can down the road.
Hey,
Throw that idiom out with the
can down
bathwater.
the
Can down the road.
Yeah, but
Throw that one
that throw the baby out with the bathwater thing, actually dumb enough, I like to look up stupid things like that. Kathy calls me the Google monster. And I looked up that one time to see where it came from. And it came from the 1500s when people used to fill up a big tub of water, keep it all day long, and when they throw the water out, throw the good out with the bad, the baby got tossed out with the bathwater. That goes back to the
That's
1500s.
like they clean their hands and then they shower and then they
Everybody
wash
takes a
their
bath in
clothes
it.
all in the same water.
I guess
Probably,
they did.
right?
Yeah,
That's
I guess
probably
so.
like you went to the well for the day, I guess.
Yeah.
Right?
And then they throw it out, and every once in a while there'd be a baby in it.
Talk about enjoying what you have, right?
We're realizing how far we've come,
Yeah.
right?
Yeah, we'll throw those sayings out with the bathwater.
So let's talk about investing in an election year. I'm going to steal a few things from Kara Murphy. Kara's our
Who will be here in a couple
Yeah,
months? She'll
yeah.
be on the episode.
Yep, we'll have Kara Murphy. She is Chief Investment Officer at Kestra and Blue Spring, and she is just a very smart lady. And I'm going to steal a few things. She just did a segment, and I won't use all her details, but she had some really cool facts that really kind of ring home. So since 1928, I'm going to read a few things here, a couple stats here. Non-election, full year average returns, if you go all the way back, it's a 7.7% average rate of return. Okay, 63% of the time, it's been positive every year since 1928. Election year returns, when you take those and average those out, it's 8%. And 75% of the election years have been up since 1928. So what's that really tell you?
Wow.
Not much difference, right? 7.7 versus 8. So there's really not that much difference if you're looking at it. And what that does is kind of take
following year, it's always gone up. Is that what
no,
you just
not
said?
always, not always.
Or not always, but
But in those years, it's that year. The non-election years, it's average 7.7. That's everything else but an election year. That's
Okay.
basically, 3 of the 4 years.
Okay.
And then the election year, the average has been 8% if you average them out.
So it's higher than a normal year.
Right. So
on the average.
But that doesn't mean that it's not, the volatility is not there. There tends to be an average volatility that is higher during the election year, the result still ends up has been averaged out to be basically the same, but it does come with more activity, more volatility. And it tends to be flatter in the earlier stages because of the and then it starts getting volatile when the uncertainty starts happening. Market always hates uncertainty, and it always jumps around, and then reality steps in, and then what's really going to happen happens.
That's interesting. So everyone's on edge, right? Everyone's got their nerves going. So
yeah, and they're also
kind of makes sense that
and they're all thinking that politics are going to be the deal. The reality is, it's not politics; it's the quality of the companies.
Yeah, it's fundamentals. That's what's got long-term performance.
That's where it goes.
Yeah.
You have all the volatility, but then reality sets in, like Mitch has said, is fundamentals of a company. So if a company's strong, I always kind of relate volatility with a good stock compared to like when you're at the beach. I'll tell you what I mean by that. You ever been swimming along, you're a good swimmer, and a big wave breaks over and you get caught underneath the wave and it's tossing you around? And guess, because you're a good swimmer, you come right back to the top. That's kind of like volatility. It's going to toss around a good solid company, but eventually that company comes back to what its real value is. So it's kind of, I relate a good company to a good swimmer. So anyway, those are just a couple things. Mitch, you got any?
Yeah, I mean, 20 of the last 24 election years have been positive. So to go off what you're saying, I mean, I think I completely agree. Volatility is going to be present in every election year. That's a given. But if the companies are doing well, then I don't think there's really any reason to go to cash on the sidelines.
What years? Do you have any idea of the years?
Which years are you talking
that they were
about?
down?
So the years, they were down in 2008. Obviously, 2000.
Who was that?
That was Obama. 2000 with George Bush, and then in 1932 and 40 with Roosevelt. So
it's a big spread.
Looking back over the time, there really hasn't been a whole lot of election years that have suffered in terms of the market. And in reality, leading after elections, the 6 months after elections have been historically pretty good. If you look at growth stocks, they average about 3.03%, and if you look at value stocks, they average about 6.5%. So if there's something to chew on for our investors looking forward, it's that, after the election, we might pivot a little bit into value stocks to some extent, because we're
seeing that rotation now.
We're seeing that rotation now already. But if you look in the past 40 years, there has never been a 6 months after an election where value has not been growth. Never in the last 40 years, which is interesting to think about. I think.
Last 40 years.
Yeah.
Well, let's
say that again. That's very interesting.
Yeah. So every presidential election for the last 40 years, in the following 6 months, value stocks have never lost to growth stocks.
Interesting.
And on average, they beat them by about 3.5%.
Wow.
Interesting.
Very interesting.
Let's go back to your 2008 and 2000. Well, when we had an Obama down, and guess what? That was not Obama. That was a mortgage crisis.
Yes.
That was caused by the banks giving money to people that shouldn't be getting loans. I mean, you could, in those days, back in 2008, you could tell the bank how much money you had, or the mortgage company.
How much you're worth. I'm worth this.
Yeah,
Can I
make
get this?
$1 million a year. And
but to that point, though, there were, I think one of the keys was that in the movie The Big Short, they talked about how, maids on Miami Beach had 5 homes, and they're maids.
Yeah.
So how does that tell you that,
not to knock on the maids.
Not to knock on the maids either, but I don't think that's
Were
5.
they maids, or were they
easy, Rob, easy.
Dancers.
Oh, okay. No.
Regardless,
no.
5 homes on a low salary
Rob,
cleaning homes is.
So what's your problem?
Yeah. So that wasn't Obama. That was the financial crisis.
Yeah.
But let's go back. So we had a Republican down and we had a Democrat down. So it doesn't matter. It's not going to really matter. And historically, it hadn't been a Dem or Republican, because we're not getting political here. We're just talking electing.
One interesting thing I want to throw in is that looking back to 1949, if one was to only invest during a Republican presidency and took all their money out and left it in cash during a Democratic presidency, they would have less than $500,000. Same thing with investing with a Democratic president. It's the same thing, under $500,000. But if one was to say invested for the full term, both presidencies since 1949, you'd have over $3 million. So it's a case study. Stay invested according to your risk tolerance.
Dollar cost averaging.
Well, that's a lump sum there.
That's crazy,
That's a lump.
right?
According to Kara Murphy, when she's talking, there's no clear correlation between the White House and the S&P 500. There really is no clear. So it really boils down to quality of companies. So basically, in summary, we're talking about here, average returns are nearly the same on election years and non-election years. Average volatility is typically higher during an election year, and there's no correlation. Typically, it may feel like it because our media is either slammed to the wall right, slammed to the wall left. I wish there was a station or a news media that lived in the middle. But unfortunately,
Want to be controversy. They want the controversy, man. They want people talking.
Fear drives ratings, and
Yeah, it
ratings
sells
drive
advertising.
advertising sales.
Yeah.
So
It's sad, kind
it
of.
makes sense.
Yep. So that's really, that's kind of what we're saying there. And, getting to what is the most important thing when you're investing, so you don't worry about should I get in, should I get out, is have the correct money invested. Some people are wondering, well, hey, I'm in retirement right now, I need to be careful. Well, be careful with different buckets of money. You got to have enough cash, enough reserves, better to have more than you need, but then have your longer term money invested according to your risk personality. So take your risk tolerance, understand it, know who you are. Don't say, hey, my friend is very aggressive and he's all in the Fantastic Seven stocks, all the big techs that have run hard. Put me in them too. And then, but your personality is a chicken, and this one is crazy aggressive, doesn't care. Well, when it does correct, you're going to overreact. You're probably going to sell them. You're going to sell them at the wrong time. Your buddy who's aggressive buys quality, holds on, is going to be fine. We'll ride through the volatility. So the most important thing is understand your risk personality and have the long-term money invested appropriately. Be diverse. Everybody's always chasing that hot stock, but the ones I see, the people I see that do the best are the people that do not micromanage the day. They have a portfolio that is diverse and it covers all the asset classes. Don't worry that your value is not running right now. Don't worry that your growth is not running. That's the value stocks or the growth stocks. But just know that each one of them will have their day, and you ride a little smoother through it.
Stop guessing.
Yeah,
Stop trying to guess the game.
Don't. And remember, the media, and don't also base your portfolio on what the media is telling you.
Yeah.
They are selling hype. They're selling uncertainty. They love hype. They love uncertainty. Think about hurricanes. They love a hurricane.
So does Generac. Generac loves
Generac loves. Let's don't go. We're not going there. We're not doing Generac. But anyway, yeah, I need a generator. It sells advertising. People always say, this time it's different. This election is different. You know what? They say it. I've been doing this for 40 plus years. Every election, they always think this time's different. They always think, okay, it doesn't even have to be election year. Okay, when they get volatility, this time it's different. It's not different. It's just
The same.
It's more the same. It is different, but it's not different in the bad or good way. Okay, remember, everybody that is a listener on this podcast is welcome to have a no-cost consultation. So please take advantage of that. We have 20 advisors here that would be happy to meet with you by phone, by Zoom, in person, and discuss your circumstances. So if you just have a question or want a formal meeting or want a second opinion on what you're doing, please give us a call. We'd be happy to meet with you.
All right, folks. Remember, the secret to success is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed. If you have a question for the guys, email podcast@bestadvicepodcastguys.com.